Good afternoon, everyone. I'm Tom Cosgrove, Senior Vice President for Public Affairs and Knowledge Exchange here at Farm Credit East. And welcome to today's 2018 Dairy Outlook webinar. Along with Chris, our Director of Knowledge Exchange, we also have Heather Hunt here with us in Enfield, Connecticut. So in our January Knowledge Exchange Partner newsletter, Chris provided an update on the Northeast dairy markets. And as we turn to 2018 Outlook, as Chris's article notes, the last few years have really been a bumpy road coming off the record prices of 2014. And certainly 2017 prices were somewhat better than 2016. So I think the big question is what's in store for 2018? To help provide some insight on the dairy outlook for the coming year, we're pleased to welcome back Dr. Mark Stephenson, who will provide his forecast and share his thoughts about what's driving today's dairy markets. Following Mark's presentation, we're also going to hear from two of Farm Credit East dairy experts, Senior Loan Officer Corey Kayhart and Consultant Gregg McConnell. They're going to provide their thoughts on the forecast and what they're seeing in terms of how producers are adjusting to the current market conditions. And I'll introduce Gregg and Corey after Mark's presentation. So Dr. Mark Stephenson, he's the Director of Dairy Policy Analysis at the University of Wisconsin-Madison. Mark is originally from Michigan with degrees from Michigan State and has his PhD from Cornell, where he spent 19 years on the faculty. So while Mark has been away from the Northeast for a few years, he's certainly familiar with New York and Northeast dairy markets. A couple of things before I turn it over to Mark for his presentation. First, here's a disclaimer relative to any actions taken based on the information in this webinar. And as Chris had mentioned, we do plan to leave some time for questions at the end. So just remember that if you have a question, you can type it into the GoToMeeting control panel with the under the orange arrow. In addition, with the recording, we're going to add a PDF of the slides as well. So with that, I'm going to turn it over to Mark for his presentation.
Well, let's get started then with the 2017 dairy situation and outlook. Well, let me start out here then. When I was asked by Corey Geiger to provide an outlook in the middle of the summertime here, I was ready at that point in time to declare that we were probably past the worst of things. We'd had price recovery already into 2017 compared with the poor price year we had in 2016. And it looked as though our competitors overseas were being circumspect about what they were going to produce. And we didn't have a great deal of excess milk production going on. And we saw some evidence that demand was picking up too. But, you know, in all fairness, over that time period, we saw milk production come on pretty strongly, not here so much, but overseas. And as you can tell by looking at the next slide, the CME contract prices, from August all the way through the current time period, we've had nothing but a tumble on the opinions of prices in both Class 3 and Class 4 for milk production. So the opinion on prices has declined more than $3 in that time period from August on through January. Let's go to the next slide and take a look at the importance of trade. And when I'm talking about the importance of trade here, I'm looking at what the U.S. is exporting in terms of a percent of their milk production. As you well know, we are exporting a significant part of our milk production now, and that's been true since about 2005. On this particular chart, though, I've also overlaid the U.S. all milk price on top of the exports that we have had for the last more than decade. And one of the things I'd like to point out to you are certain time periods here when we've had our U.S. all milk price that's fallen considerably from the high point that it was at. And if you look on the orange line, you'll see the highlights there showing you when we've had low milk prices. And they correspond to points in time on that blue line where the exports have actually either plateaued, you know, been off trend where they had been increasing previously, or they've actually fallen. If you take a look at that 2009 to 2010 time period, you see a substantial decline in exports and a real big tumble, of course, in milk prices. Well, we've had a pretty big fall for milk prices since 2014 as well. And you'll notice that this is corresponding to a time when our exports are well down. So dairy trade has become really very important to the U.S. dairy industry. We all know that. And it's one of those things that we not only have to acknowledge, but also have to look to when I think we're hopeful for price recovery. So we'll start on this end with trade. When we aren't able to sell as much dairy product overseas as we had anticipated, we tend to have our stocks of dairy products begin to back up. So if you can move to the next slide, the American cheese stocks, you will see that our cheese stocks had been at a relatively low level in 2014 when we were selling quite a lot of product and prices were very high. Our stocks, in fact, did not build very much during that season of the year when they normally do. We were selling product. But through 2015, when our exports began to fall, stocks began to build. And in 2016, those stocks maintained fairly high but level throughout that year. And in 2017, this past year also, we've seen a building of those stocks. More recently, the last couple of months, we've seen a pull down to some extent. But nevertheless, we've got a lot of cheese stock product on hand. And those heavy stocks really begin to weigh on price opinions, and you can't hold them for very long until prices begin to fall. And we have seen a lot of downward pressure on the prices as a result of stocks. Stocks, I think, are one of those things that's kind of like the canary in the coal mine. If you really want to keep an eye on where you think prices are likely to go, watch the stocks of cheese or non-fat dry milk, that type of thing. It's going to give you an indication of where price pressures are probably going to come. If they're on the short side, we're going to have good prices coming. If they're on the heavy side like they are now, we're likely to see prices under assault. Let's go to the next slide. One of the questions we might ask is, why has it been so long? When you actually take a look at this slide, which is looking at a % change in milk production from a year earlier levels, it shows both the US in the red line, and it shows all 5 of the major exporters on the world markets, which includes the US. We're number 3. So this includes New Zealand, Australia, the European Union, Argentina, and the US in that dashed black line. And through 2016, there was quite a bit of contraction, not so much from the US, but from other exporters. And over this last year of 2017, we've seen a response on the part of other exporters as they've been increasing milk production. Our U.S. milk production has maintained fairly level, stable increases. But the competitors for those world markets have really taken off. Let's go to the next slide and look at the intervention stocks at the European Union. You'll notice here that the red line is showing you U.S. skim milk powder stocks. And you can see that through all of 2017, those skim milk powder stocks for the U.S. have grown a bit as well. But before that, the European Union was trying to relieve farm milk prices by having a program that was similar to our old program here in the U.S., where the country would buy storable dairy products and hold them. And the EU does that with their intervention program. They bought skim milk powder and they've been holding that. And that powder has accumulated to well more than 360,000 metric tons of product. And it's a considerable amount of product that's weighing heavily on world markets. Everybody's expecting that that's going to come out of storage at some point in time and retard the recovery that we're expecting. So between the US and the intervention stocks in Europe, we've got a lot of powder, and that's put a great deal of downward pressure on skim milk prices here in the US. If you take a look at the Chicago Mercantile Exchange, these graph on the next one here that show non-fat prices are showing you the decline in spot prices for non-fat dry milk. These are the daily prices that people are either bidding or offering or trading, selling on the CME. And you can see that they have declined over the course of 2017 from more than $1 a pound for non-fat dry milk to less than 70 cents a pound currently. Been a lot of downward pressure. So those stocks are weighing pretty heavily on the marketplace. I would say that skim milk powder that the European Union has had in that holding pattern there for some period of time is not the same product that went in a few years ago. Powder lasts a long time in storage, but it does deteriorate, and it's not suitable for all kinds of uses after a certain point in time. For instance, you won't find very many cheesemakers that would want to purchase that powder to put in their vats to make cheese, because it simply isn't going to yield like fresh powder would. It's probably more of a direct substitute for whey protein concentrate 34 or something like that, and maybe used more for animal feeds or in products like ice cream, perhaps, or yogurt, where you simply need skim milk solids. But it's not going to give you the yield in a cheese vat. So this product is going to have limited use in the market when it does come out. Let's move to the next slide, and I wanted to show you just an example of what I mean when I talk a little bit about why we continue to produce. We can ask ourselves the questions, given these prices that have been low going into the 4th year now, or relatively low, why do we continue to produce milk? And I think the simple answer to this is that we have not fallen down into our variable costs of production yet as far as prices are concerned. The chart is showing you an example of, roughly in the United States, what we have for fixed costs of production on farms. Those are costs that you're committed to for the long run. So for example, if you build a milking parlor, that's not a short-term cost. That's a cost that you're going to be paying for some period of time. But feed is a variable cost of production. Feed is one of those costs that if we didn't milk a cow today, we don't have to feed that cow. So we don't have or experience that variable cost. And it makes sense for producers to continue to produce as long as they're covering at least their variable costs of production. The milk price has not fallen really down below variable costs for most producers just yet. However, for farms like New Zealand, their total cost structure is similar to ours, but the makeup of the costs are different. They tend to have relatively low variable costs of production and high fixed costs of production. For them, they're still losing money because they aren't covering total cost, but they're not conflicted about what they should do. They should produce as much milk as they can for the amount of grass production that they have available to them. And the reason that this price trough seems to be lasting this long is because milk prices haven't fallen so far. 2009 was when we had a tremendous drop and decline in milk prices, and that caused people to cull herds rather heavily, or in fact go out of business for a number of farms too. But it was a deep enough cut that it abruptly changed our production behaviors. We aren't seeing much of that happening just yet. This is more like a long, slow scrape rather than a deep cut. But over time, that capital that we've been committed to really starts to need to be replaced. And rather than replacing it, we've been repairing it and scrimping along with it. And those capital costs begin to be more variable in terms of the repair bills we've had on there. And we're seeing evidence of open accounts growing and other things. So I think that we're getting to a point where producers are likely to slow down on milk production. That's why we continue to produce. Let's go on to the next slide and look at what's been happening to milk production per cow. We've had increases, certainly, of milk production per cow this year, 2017, or the year past, but they've been fairly modest, especially for the last 3 quarters of the year. We've had not great prices, and that's not encouraged strong milk production. We've had some regions of the country, like here in the upper Midwest, where we have given up on products like RBST on most farms. And we've also experienced poor quality feeds for a portion of that time period. So in the US, our milk production per cow has increased, but not as large as it was, say, in 2016, where we had a big increase over the previous year. Milk production per cow is half the story. Let's go to the other half, which is the next slide, number of dairy cows. The number of dairy cows is the thing we start to dig into when we're really getting serious about slowing down or cutting back on milk production. We don't do much of that by slowing milk production per cow down. But you can see that in 2014, tremendous milk price year, we responded by adding cows pretty strongly. 2015 was more of a holding pattern year. 2016, we actually added a bit of cows at the end as prices began to revive, and through the early part of 2017 too. But the latter half of 2017, we've been holding pretty flat. But we really haven't started to cut back on cow numbers. So our milk production has been increasing in total, mostly due to the production per cow, not so much number of cows. Let's go on to the next slide though and look at the percent change in milk production. And the percent change in milk production is shown here with a little bit of ups and downs. And if you advance the slide another time, it will probably give you an animation of a bar on there that is showing you that band between 1% and 2% is a normal range for the US increase in milk production. This is taking care of our increase in population domestically. It's taking care of our increase in milk production per cow, the productivity that we have. And, you know, it's also taking care of our increased opportunities for exports. But our opportunities for exports haven't been great lately. And you'll notice that we did have a resurgence in milk production on the latter half of 2016 and early part of 2017 when we had the rebound in milk prices. But since milk prices have been on the decline and optimism has slowed, so too is milk production. We're down now, approaching that area that will get at 1 or below 1% increase, which I would say is really kind of a contraction for the US. And by contraction, I don't mean that it's actually negative production. It's growth that isn't enough to keep up with our domestic demand increases. So milk production in the US has been fairly circumspect. Let's go to the next slide and take a look at regional changes in milk production. This slide is showing you the first half of 2017 compared with the first half of 2016. And there's some pretty stark differences in states that have increased milk production versus those that have contracted or lost milk production. Maybe I'll start on the end with those pink to red states, the states that have lost milk production. California, our #1 milk producing state, has really been in a tailspin for almost 3 years now. That state shown here is looking at a 2% decline in milk production for the first half of 2017, but 2% from our largest milk producing state represents a lot of milk production. In fact, if you take a look at the last 3 years, California has lost something like 6 million pounds of milk per day in milk production over that 3-year time period. That's one large plant. And so we have a number of plants in California that are not operating at capacity. Now, if you take a look through the rest of the Southeast, you'll also notice quite a lot of loss of milk production too. And that's really following on a long-term trend that we've seen down there. That region of the country, with the exception of Georgia and Florida in a couple of years, has had loss of milk production, and they've really had a difficult time with that loss of production and increased population growth. They've become very net deficit. But through the northeastern quadrant, and from there I'm including Pennsylvania and New York, I'm including Michigan, certainly they're kind of the poster child for increase in our region, and Wisconsin. We've all increased production quite a bit. And this last year of 2017, we've also had states like New Mexico and Texas really joining that club of increases too. They've increased pretty dramatically. Let's move on to the next slide, which is another slide of state level milk change, and that's comparing the year 2016 with the year 2015. I'd ask you to maybe hit your advancer again, and it should put kind of a yellow line across the states. That line is a change line for me. When we look at states north of that line, there are only 3 states that have declined in milk production in 2016 compared to 2015. That's Montana and Massachusetts and Rhode Island, not big milk producing states. Every other state north of that line increased in milk production. If you look below that line, we've had declines in milk production in every state except 3 again, and these would be states that increased. That's Arizona, Texas, and Georgia. All the other states had declined. If I showed you 2015 compared to 2014, it would look very similar to this. I mentioned that California over the last 3 years has declined in milk production about 6 million pounds of milk per day. But if you look at the region of the Northeast here, including Pennsylvania, New York, Michigan, and Wisconsin, these 4 states have increased more than 15, almost 16 million pounds of milk per day. That's essentially 3 very large plants that we probably need in the way of capacity to take up the slack of the increased production. And I do know that there in the Northeast, you've been having some problems from that from time to time when you've had seasonal surges and not been able to find a marketing home for all of that milk. That's put some certainly downward pressure on milk price premiums paid in the area. And I also know that we've had a few farms who have had notices of loss of market. We've had the same thing in Wisconsin, which was a big shock to producers here in the state earlier in 2017. But let's go on to the next slide. This slide is showing you milk production per cow. I mentioned that our increase was a little bit tepid this last year, 2017, but boy, over a very, very long run period of time, we've seen that that increase has been ongoing. And we're currently more than 23,000 pounds of milk per cow across the U.S. Pennsylvania, I think, is lagging that rather considerably, but most of the states are doing reasonably well, and on average, we're increasing milk production fairly substantially. That increase in milk production per cow, though, has given us some additional problems that may be explaining some of the changes that we see in where milk is being produced, and in particular, that southeastern region. These cows moving up to higher levels of production are also animals that are metabolically much more active. They're the ones that are able to eat a lot of feed and turn that into milk production, but they also have a lot of body heat to dissipate. In fact, I'm told by our animal scientist folks that going from being a 20,000 pound producer to a 30,000 pound producer, the cow has about 30% more body heat to dissipate. And that's getting harder and harder to do in the hot and humid areas of the country. And in fact, it's getting hard to do even in the just plain hot, but not so humid regions of the country. Let's go to the next slide where it says considering 4 trends or trends in top 4 milk producing states. These, of course, are the states of Wisconsin and California, New York and Idaho. The top 2 states up there shown in red and yellow colors are California and Idaho, and the blue and green lines are showing you monthly milk productions in Wisconsin and New York. And I think you can see that there are some very different trends going on in these top 4 milk producing states. The western states are showing you it's just a very modest trend of increase in milk per cow per day. And in fact, almost a plateauing in the last few years, whereas the states of Wisconsin and New York have continued to grow milk production, and in fact now surpass milk production per cow in states like California and Idaho. This is a very different change, but this is putting some pressure on regional milk production. These are animals, I think, that are responding to the problems of heat, and in some sense, we have a term that's been thrown around in the West of the browning of California and Idaho. And by browning, they mean prevalence of colored breeds coming in there. Many more jerseys that are more heat tolerant and perhaps more efficient feed converters. And so milk productivity has been tailing off in those states. Let's go to the next slide and take a look at changes in the dairy ration, or the value of the dairy ration. This is the Margin Protection Program ration value, meant to be an indicator of what it takes to produce 100 pounds of milk and to support dry cows and calves and heifers. You'll notice that our feed prices have declined since 2012. They've been in a fairly stable, little bit of up and down range over the past few years, but nevertheless, they've been fairly modest for us. So our feed costs have not been particularly high in this past year. The bigger problem has been milk prices. Let's go on to the next slide of consumer confidence. There's a monthly survey that's done that is asking consumers how they feel about the economy and their confidence in the economy. You can see from this slide that consumers have had a strong response since the recession of 2009. Their confidence in the economy is at an all-time high currently. It certainly had declined going into that recession, but ever since that time period, it has increased a fair amount. But let's move to the next slide, which includes this very same consumer confidence line, but breaks it apart into two other pieces. They ask two different sets of questions of consumers when they do this survey. One of them is, how do you feel today about the economy? And the other one is, how do you feel about the economy over the next 6 months or so, the near term? What are your expectations? And I point this out because the consumer confidence line, the red line, is the average of the current situation and the expectations. You'll notice that in 2006, 7, and even early 2008, consumer confidence in the present was really strong. Consumers felt good about the economy at the current time, but they were worried about the future. And that worry about the future has a tendency to make consumers conservative about what they're willing to spend money on and how much they're willing to go out to eat, for example. And that has implications, of course, for consumption of dairy products as well. During that time period of the recession, we saw consumers not go out to eat in restaurants, and restaurant performance was well down during that time period, but they stayed at home, and we actually had a small resurgence in fluid milk sales. So, it had implications for changes in dairy product consumption. Since that time period and our consumer confidence recovering, you'll notice that at the end of the recession, people were saying, well, it's not very good today, that low blue line, but I'm optimistic about the future, the green line. And that tends to buoy our thoughts about what we're willing to spend money on and pulled us, in fact, out of the recession. I only bring all of this up because as we look at the last 2 or 3 years here, we've seen this divergence happening again that we saw in 2005, 6, 7, that time period, where consumers' expectations are much lower than the consumer's present situation. And I am not suggesting that I'm concerned about the overall circumstance for sales of dairy products, but we've got consumers that are getting nervous about our current economy. Maybe we're asking questions like, can the stock market continue this kind of surge that it's been on? Should I become more conservative about what I'm spending money on? And let's keep that in the back of our own minds as we think about the next year ahead. Let's move to the next slide, where I'm looking at the Bureau of Labor Statistics Index of Dairy Products. This is just showing you that retail prices of dairy products have really been a pretty good buy for consumers. 2014, when our milk prices were high, we hit the height of high retail prices for dairy products in stores as well. They've been coming down since that time period. So consumers' confidence is also being met with relatively lower dairy product prices in the stores, and consumers have responded. We've had pretty good domestic sales. But let's move on to the next slide where we look at the fluid milk sales. I did indicate that in 2009, we saw a slight resurgence in fluid milk sales. You can see that little bump there. But since that time period, fluid milk sales have been falling all the way through 2017. And this has not been a very good trend for the dairy industry. But I also caution you a little bit about becoming too depressed with this. We've had a lot of consumers that have been category shifting. So maybe not consuming as much beverage milk or using it for cooking in the home as they had before, but we're consuming other products. Let's go to the next slide and look at per capita milk equivalent consumption. This slide is showing you that when we look at all dairy products here in the US, we've actually been on an increase in milk production or milk consumption, and now consuming well more than 120 pounds of dairy product per year. In fact, we increased just about 2 pounds of milk per person per year, and our population is growing. So domestically, our sales have been reasonably good. One piece of evidence of that is cheese consumption, which I don't show here, but you know, cheese consumption back in 1975 was around 15 or 16 pounds per person. Today, it's more than 36 pounds per person. So cheese has been a real bright spot long-term for the industry, and I don't think it's out of gas yet. If we take a look at some other countries like Germany or France, we can see that per capita consumptions there are more like 50 pounds per person. So 36 is a strong amount of consumption, but we probably have room for even more cheese consumption. Let's go to the next slide and look at the Global Dairy Trade Index. New Zealand has been conducting this global dairy trade sales of product, and it's an interesting auction of dairy product. These are auctions that they bring on with a known quantity of product every 2 weeks, and they put these out for bids for delivery in the next several months. They have 3 different time periods of the auction, so it's almost a little bit like a future price as well as a present price. And they will run the auction until those sales are just exhausted. In other words, if they don't sell enough dairy product, they go back and they lower dairy prices, and they wait to see until those sales are just exactly met for what was offered on sale. Now, the Global Dairy Trade Index had really fallen dramatically through 2015 and 16. We saw some optimism in 2017, and you can see where my price forecast earlier in the year gave us a little bit of strength given the Global Dairy Trade Index. But since the middle of 2017, the Global Dairy Trade Index has been falling yet again as we start to see a pessimism about the amount of dairy product that's available on world markets and the demand for dairy products that people are willing to buy. So let's move to the next slide and look at other factors that are influencing trade. Our strength of the US dollar certainly has an impact on trade. A weak US dollar, like we had relatively speaking back in 2012, 13, 14, was good for dairy trade. When our dollar strengthened through that 2015-16 time period, that's not so good. It makes our US product look relatively more expensive to buyers overseas. Since 2017, however, we've had a modest weakening of the US dollar. That is offering a little bit of relief. We may hope, I suppose, that the dollar could weaken a little bit more against other currencies and make sales a bit easier for us. I would call the strength of the dollar more like headwinds. It doesn't mean that we can't sell dairy products. It may mean that we have to offer them at a slight discount to other competitors in world markets, but it doesn't mean that they can't be sold. So our dollar has been weakening just a little bit. Let's go to the next slide and look at price cycles. Now, you'll have to hit the forward key one more time to bring these cycles up one at a time. The first cycle was this 2001 to 4 time period, and this is not a cycle of just milk prices. This is actually the margin protection program margin. So the difference between milk and feed prices. And I'm defining a cycle as starting at the high point of a time period and going until it hits the next high point. And this particular cycle of 2001 through 4 had about 34 months in length, and it started at a peak around 12, ended at a peak around 12, and hit its trough around 6. Hit the advanced key again, and we'll see a green line for the 2004 to 7 cycle. That cycle lasted longer. It lasted about 44 months, and it was a cycle that didn't get quite as low as the previous one, but it did hit lows well below the $8, what would have been payment under MPP had you had the program in place and been covered there. But it also ended on a really strong note with $14 margins. That $14 margin kind of gives us a signal to produce more milk, and we do that, and it often leads us then into the next downturn of cycles, which we saw in 2007 through 11. Let's hit the advanced key and show the red line. This, of course, included 2009, which was the brutal year that we had with the bottom of a margin actually close to $2. So you only had $2 to cover all other expenses of producing milk other than feed, which was accounted for in this measurement that we have here of margin. The cycle started high, but it was a long cycle, one of the longest that we've seen, and I think lasted 47 months during that time period. Let's hit the advanced key to the blue cycle of 2011 through 14. This was more of a low margin due to high feed prices back in 2012 than it was low milk prices, but prices were relatively low then as well, milk prices. And let's hit the advanced key again to look at where we are in our current cycle of 2014 through currently 2017. Black line is showing you our decline from the peak, and it's not been a very low bottom. We hit just about $6 margin, and we recovered a little bit here in 2017, early part of 2017, but we've since been brought back down here, and we're now looking at what I'm going to forecast to be one of the longest cycles we've ever had. The reason is that we are expecting this to be a downturn now as well in the next several months. So pulling ourselves back down below $8 range through the first quarter at least of 2018. So this is going to be a long cycle, and it's a cycle that hasn't been brutal in its depth, but it's been brutal in its length. Let's go on to the next slide and look at the alternative to producing milk. Back in 2014, when milk prices were high, we also had high cull cow prices. This was mostly due to a depletion of the beef herd, and that gave us a real opportunity to cull cows when we didn't really want to. But since that time period, the beef herd has recovered reasonably well, and we've had cull cows that have been selling at really quite a discount from those high levels. It's not a strong incentive to get rid of cows right now, and we have a lot of heifers waiting to replace those cows even when we do sell them. So cull cow price is not a bright spot for creating some room in milk markets right now. Let's go on to the next slide where I get down to my actual price forecasts. I'm showing you 3 different price forecasts here. The actual lines are shown as solid lines, and the price forecasts are the dashed lines. The dashed red line is class 4, the dashed blue line is class 3, and the dashed green line is the US all milk price. You can see the forecast that I have here going into 2018, where I'm expecting a decline in all of these for a period of time before we begin recovery more toward the second half of 2018. I think we'll start to pull out of the bottom, but my guess is that the February-March time period is likely to be the bottom of this next little trough that we're going through. Let's move on to the last slide out here where I talk about my forecast. Good news is that our relatively strong U.S. economy is helping us consume dairy products. I want us to be just a little bit wary that, you know, we've gone quite a period of time now without some kind of slowdown in the economy or recession. Our tax relief may provide a continued stimulant and keep us going for a period of time, but sooner or later we will have a slowdown in the economy as well, and consumers seem to be a little bit nervous about it. We've had a surprising demand for milk fat. That's been true here in the US, and it's been true in a lot of other countries as well. I think that milk fat is more of a luxury item than proteins. When we saw the tremendous surge in buying of skim milk powder by China and even by Russia, this was when we had a lot of people moving into a stronger position in middle class and wanting to upgrade the quality of their diet. In other words, get more animal proteins in them. But as some of these economies, the Chinese economy in particular, has moved up into even greater levels of income and wealth, they've had the opportunity to improve the quality of their diets, not just by protein, but also by butter fat. And so China is looking more at purchasing items like cheese and butter, which is not a bad thing, but across the globe, we've had a real strong demand for milk fat. That's been a bit of a pull for us. The world, however, is awash in milk proteins. We either have to do one of two things: find new and emergent economies like China was a few years ago to purchase some of these milk powders. That is what we would call a shift in the demand curve, and that lets us sell more of the skim milk powder at, you know, current or even higher prices. Or else we need to explore the demand for skim powder on the current demand curve, which would be a move down that demand curve to lower powder prices. We've got too much product in stock, and it simply has to move. The southern hemisphere of the globe is halfway through their production season, and we've had countries like New Zealand that started out with a bang, actually almost excessive rains on their pastures, but they have gone from excessive rains to significant drought. The El Nino that we're actually in right now is providing dry pasture conditions for them, and it's taken the top off of their milk production. That won't recover this year in the production season, so I think that New Zealand is going to be lucky to even meet the kind of production they had last year, let alone exceed that by any particular degree. Same thing is true for countries like Australia and Argentina. So when we look north of the equator to the northern hemisphere, it's primarily the US and the European Union. And the European Union is really in the driver's seat right now as far as milk production is concerned. They're still expanding and growing significantly. They're the ones that are putting a lot of downward pressure on our current milk prices out here, which is why I say European Union's in the driver's seat. If you can hit the advance button, I'm going to say that unless circumstances change significantly on the export side, I think it's pretty hard to be very optimistic about milk prices in the long run. And if you advance again, the last point I would have is that I'm forecasting 2018 prices for class 3 to be down by about $1.35, class 4 down by 85 cents, and the all milk price down by $1.55. It's down by more than class 3 or class 4 because we're seeing declining premiums, and class 3 and 4 are minimum regulated prices. And although we've had premiums being paid in most parts of the country, we've seen them diminish in the Northeast and in the upper Midwest all through this time period as we're responding to a lot of milk production in this region. Basically speaking, the 2014 milk price, I think, or 2018 milk price is going to feel a whole lot like 2016 was. And I'm sorry I can't be more optimistic than that. But that's the end of my presentation, and I'd be happy to take questions if we had any right now.
Okay, great. Well, thank you, Mark. Thank you for that excellent presentation. Certainly look forward to a few questions and discussions here shortly. Just a note for our participants, we'll probably go a couple minutes past the top of the hour, but we will have a recording for those who do need to leave at 2 p.m. But right now I'd like to turn over and turn to two of our Farm Credit East staff members, get their perspective. These are folks who are out working every day with producers. So first I'd like to introduce Corey Kayhart. He's a senior loan officer in our Geneva, New York office, and he manages a $170 million loan portfolio, and most of that is dairy production. And then we're going to hear from Gregg McConnell. He's a business consultant who also works with customers in Central and Western New York. Gregg was on the lending side of our business before moving over to the consulting world and works with a number of Western New York dairies, leading monthly or quarterly profit improvement discussions. So let me first turn to Corey. Corey, any comments on Mark's forecast or things that stand out to you? And just would like to get your take on, what are you hearing from the producers you're working with from the kind of the financing and capital spending point of view?
Yes, thanks, Tom. I think the take home, $1.55 less than 2017 milk prices. So as Mark alluded, we're going back to the 2016 pricing cycle, and we're entering this season with less healthy balance sheets. So we're coming in with less liquidity, higher debt per cow. So it's certainly going to be tight times. I looked back to our 2016 dairy farm business summary, and that showed a net cost of production of $16.79, with the average producer making about $15 a cow. So as we kind of gear up for that, how much more, I guess, loss or erosion can our balance sheets withstand? So from the lending side, this kind of leads to the challenging question of what are you doing as a producer to cash flow through this down cycle? So from a capital spending standpoint, I think guys are going to hold pat for the most part. There'll be limited spending as the balance sheets really don't have much capacity to take on additional leverage. Where we do have spending, I think it'll be limited to the high return on investment projects, where you're gonna, increase milk production quick, add cows, and really focus on your fixed and variable costs, as Mark alluded to. I think from my perspective, I would argue that most dairies have reached a point where they have a marginal fixed cost issue, and more of the focus needs to be on the variable cost side. So, looking at your heifer inventories and your feed inventories and how you can adjust those to drive down cash costs in your business and really make it through these tight times. I guess I'd wrap up by saying, overall our managers have done a good job in bringing down their costs to maintain their capital positions, but this needs to continue to remain viable in the future.
Okay. Well, great, Corey. Appreciate those comments. Gregg, how about you? Any key takeaways from your standpoint? As you're working with producers, what are you seeing from kind of the strategic or other management and operational changes that producers are doing?
Yeah, Tom, I wrote down 3 key takeaways from Mark's presentation. One, we're still more than ever driven by a world market with respect to milk prices. Something to keep in mind that you can control the controllables, but some of these things are outside of our control. So a lot of impact from whether we can export or not. Another takeaway was milk price basis. So on the local side, we've got a lot of milk in the Northeast. Mark indicated that his projection included a basis reduction of around 20 cents. At least that's what I imputed from his overall, when I say basis, it's the gross milk price compared to class 3, the difference between the two. So in the field, we're using the same kind of basis adjustments on our projections for 2018, and so that's a big impact on milk price. I also really liked Mark's slide, and I thought it was a huge takeaway on why do we continue to produce in such a low milk price environment, and his point being that, you know, low milk price hasn't been low enough in a sense, not sharp enough to get farms to cut production because we're still covering variable costs. I bet you Corey and I could recite over and over where our mutual clients will expand a dairy because they're able to dilute their fixed costs and they're still making money on a variable income over variable costs, thus the increase in cow numbers and production works. So all these things tie together into what are the strategic and management techniques being used. In my portfolio, my typical farm, I vary between 400 cow dairy up to about 4,000 cow dairy. And these farms, you know, are generally progressive operations, and you know, most of them, where they're able, if they had recent expansion, they're filling up their barns and getting those operations more in balance with their resources. They're trying to maximize parlor capacity, and then once they get to that place of sort of right-sizing the operation, they're struggling as to what's the next step. You know, Corey mentioned the capital spending, you know, appetite, and how, you know, there's some impacts there with these kind of milk prices, and my clients are in the same boat. It's kind of hard to know where to go in the future. I see a lot of farms focusing on better use of land, really pushing a lot of putting tile in, getting yields up, and that's been a real boon to our production efficiency on the crop side of things, which has resulted in a lowering of variable costs. And then just tuning up the sort of the income over feed cost variable. I see a lot of farms in my portfolio producing high volumes of milk in 2017. Some of that was weather driven, but some of that's just nutritionists really working hard with their clients to develop high component milk and high milk per cow. And we've seen production levels this year in my region that frankly are pretty stunning. We do see that not being quite as easy to do in 2018 based on what forages we have this year. So operationally, you know, still working on that income over feed cost, still cutting costs where you can. Those are all good venues. But I got to go back to what Corey was saying. How low can you go? We saw from 2015 to 2016, we saw net cost of production in the Northeast Dairy Benchmark drop $1.57. And if I polled your group, Tom, here today, I would guess that most would say we can't do that again. And you know, the group of farms that I work with in the Western region do some real-time benchmarking, and I will stick my neck out to say that it appears that net cost of production is relatively flat in our region in Western New York. With the milk prices in 17, I'm hoping for an 80-cent per hundredweight profit, which and maybe with crop inventories, maybe we can see $1 profit in the Western region of New York on average for 2017. But if we run Mark's projection into 18, and after factoring in what I believe is a relatively flat net cost of production again next year, it looks to me like we're facing a 50-cent loss per hundredweight. So we're looking at $1.50 less profit per hundredweight next year, and that would equate to around $160 loss per cow. For a lot of farms, their debt payments are in excess of their depreciation, which means we're going to see deficits that approach, you know, $500, $400 a cow, somewhere in that ballpark. So yeah, this is a time when the balance sheet's important, and I must finish my comments saying that with what Mark Stephenson calls a slow scrape, and that is pretty much a great description of what it is. We have balance sheets that have been eroded on a lot of farms to a point where it's going to be hard to survive that kind of deficit this year. And I would argue as well that that deficit will be front loaded in the first 6 months. So we are dealing with some stress, and I think it will have big impact.
Okay. All right. Well, good. Certainly appreciate the thoughts from both you and Corey. So as I said, we are at the top of the hour. We're going to stay on a few minutes to take some of the questions that have come in. I will try to get to as many as I can. May not be able to get to all of them, but again, appreciate those comments. So Mark, one of the graphs that kind of caught the attention of many of our participants today is on the consumer confidence. Someone asked if there was a long enough history. You pointed out that there was a similar kind of divergence between present and expected consumer confidence in the prior to the recession in 2008. But how far back does that go, and is that an indicator? And then someone else asked about do policy changes, like for example the new tax bill, are those the kind of things that could impact consumer confidence? I'd just be interested in your comments on that.
Well, thank you for the question. It's a good question. The U.S. used to be a manufacturing-based economy. We made things, we sold things, and that was a lot of what drove the kind of incomes and wealth that we saw in throughout the country. We've since become more of a service-oriented economy, and we base an awful lot of the kind of wealth or GDP that we generate here on the basis of consumption. And so consumption is a thing that can be really dangerous for us, as it was back in 2009. When we slowed down or stopped consuming things at the same pace, we actually put ourselves into this tailspin that gave us the recession. We aren't there yet, in my opinion, but we've got enough of a divergence going on currently between the way we actually feel today versus our concerns about the future, that if we start changing our spending patterns again, we can put ourselves into a recession pretty quickly. So in my opinion, all this would take would be some really kind of bad headlines. In 2009 time period, we got that with Europe, for example, concerns about sovereign debt in countries like Greece and other things. And so stock market kind of began to tumble. If we got bad news from other reasons or regions of the world, like rattling our nuclear saber, then this could cause some of the same kinds of concerns that we would see in spending patterns. Would not be good for the economy. So I do have a concern about that, but it's not one that's reflected in what's happening today on spend. Consumers are spending money right now, and our economy looks pretty good. But I just throw this up as an early warning sign. We've seen this through other time periods before. On that graph, I only showed you going back through that time period that gave us the last recession.
Okay, great. So Mark, we've had a couple questions in on, I know this focus on presentation focuses on the conventional milk market, but we have had a couple questions related to organic or other specialty type milk classes. What are you seeing in those markets? If you have any comments in terms of that outlook, is it similar to what you see for conventional milk?
It is similar, although we've seen in the past more than a decade, that organic has had the opportunity to weather some of these ups and downs in prices better because they had more of an inelastic demand for their products from consumers. One of the problems that I think we're experiencing at this point in time is this incursion of sales of other beverage products, the nut milks and rice milks and those kinds of things that are competing more strongly against an organic market, I think, than the conventional market. and it is causing some problems. We've seen a real lack of growth in organic sales, and that's causing some real price problems with the organic market right now.
Okay. Well, there are a couple questions about exports. I think, you know, obviously the data that you showed shows that clear link between exports and where price levels are at. So one question was, you know, is there something from a innovation standpoint in terms of the products that we are exporting that needs to be done differently? And then, you know, I guess related to that is, what kind of increases would we need to see in terms of our percentage of exports to see some significant increases in, say, the Class 3 prices?
Good questions. We've had an uptick in cheese sales recently in exports. Countries like China and other Southeast Asian countries have been purchasing more of that product. And, you know, it's something that we hope will actually continue. We've had a pretty strong report coming out with the latest data that we have, which is November for export sales. But, you know, and we've got to meet customers, whether they're overseas or domestic, where they are and what products they want to see. Initially, and I'm talking about like more than a decade ago, when we really started getting into these export markets, you know, we basically were bringing the products that we made and said, well, here, you know, buy these. But the rest of the world doesn't want 40-pound blocks of cheddar cheese. You know, they want a Gouda product, and they want it in kilograms, not, you know, in pounds. So we've had to learn how to sell dairy products and do a better job of that, and we've got a lot of companies that are doing a good job, but it's still early days, I think, for us as exporters, and it's a shifting world. We need to find our consumers in other parts of the world as well. I would certainly like to see a little bit more of our powder products moving, not just you know, a little bit of cheese sales happening, but powder products as well.
Okay. So one of the questions came in related to the Farm Bill, and obviously this isn't a policy discussion per se, but this is a Farm Bill year. Just wondering if you'd have some general comments on what, you know, potential policy changes could mean in terms of the dairy outlook.
Well, you know, I will say historically for us, it's probably a good sign as we go into a Farm Bill that we're having problems on so many fronts, agriculturally speaking. Usually, if we have, you know, pretty good prices going on, it's difficult to find a sympathetic ear in Washington to make much in the way of change. I think it's still going to be difficult going into Washington this year with a Farm Bill, even though almost all of agriculture has been having just a significant amount of problems to have real modification of these programs. For dairy, I think the most likely thing is that we're going to see modifications to the margin protection program. That could be a lowering of premiums. That might even be an expansion of the margin that could be covered. There's been discussion of taking it up to $9 instead of the $8 level of coverage. And maybe even increasing what the historic level of production could be, rather than that first tier at 4 million pounds, maybe going up to 5 million pounds. So those things don't necessarily change the sensitivity of MPP or when it would pay more, but it at least allows us to have the possibility of a really inexpensive put option essentially on milk prices. So that's kind of what I expect. I think we're going to hear much more in the way of discussion about Farm Bill as soon as the decks are cleared. It's my understanding that Washington's already written a fair amount of what would become the language of the Farm Bill, but they're not going to bring it to the floor until they think that they can move pretty quickly on it and get passage. So they aren't going to bring that up for a few more months, in my opinion.
Okay, great. So I'm going to send one question over to Corey and Greg, and then I'll have one more question for you, Mark, and we'll finish up. So Corey, I'll start with you on this one. You know, I think the question came up, and I think it's embedded in the discussion we're having today, that sometimes what might be best for the individual farm in terms of adding cows or increasing production per cow, obviously, you know, affects the overall market. And so I just want to get both yours and Gregg's just a quick comment on, you know, how do you balance those considerations, but, you know, how do you work with farms in terms of figuring out, you know, what's right for them in terms of, you know, their marketing arrangements, their cost of production, and considerations like that. So, Corey, why don't you offer a comment on that?
So I think it, you know, it's a case by case basis, and it all really depends on your overall financial position and what you can withstand from a capital perspective, and then what it's going to do to your cost of production. You know, if your business is trending in the right direction and able to decrease your cost to a sustainable level, and the project in a year like this has a high return on investment, then it's, you know, it's something that can certainly be evaluated. But you know, it has to be the right move for your business, and we can't make a decision on who's gonna survive in the industry by doing a project or not. It's you know, it's up to the individual consumer or individual producer and how their business is going to withstand the low milk prices. So,
and Gregg, I would assume another is you work with the customers that you work with, that obviously making sure that the marketing arrangements that are in place if projects like that are going to be taken on.
Yeah, that's a first step, is making sure your milk market will accept more milk, or what the terms are under which they will accept it. And that factors into our analysis. But yeah, it's really a question of microeconomics versus macroeconomics. On a macroeconomic basis, it might be nice if milk supply dropped, you know, 2% so that price could go up. But on a micro basis, on that particular farm, if we can drive net cost of production down by a few more cows or a little more production, we'll certainly run the numbers and see if it works. I would say that, you know, in my practice, in my consulting practice, I avoid saying, well, I actually am known to say that bigger is not necessarily better. You know, you need to manage what you have well, and that's the first step. And then, you know, getting bigger is appropriate for some, especially if it's just sort of trimming up their overall resource base. So, but certainly large investments right now, I'm pretty negative on that, unless there's a strong, compelling reason why it works for that particular farm.
Great, thanks. All right, so last question here. Have Mark finish it off. Question, I think, kind of a good one to end on in terms of the big picture themes of your talk, in terms of why have the price cycles in the chart that you showed with the lengthening of the price cycles. What do you think is driving the fact that they are lengthening, and is that likely to be the case going forward?
I'm not really convinced that we've got that kind of statement we can make. In other words, I'm not sure that you know, our price cycles are just getting longer each time we have them. I think that we've got no particular evidence of that. We do see some longer than others, and that's possible. Also, in my opinion, I think that having these cycles where we don't bottom out very deeply is likely to give us longer cycles. So if we have a deep bottom or trough, I think producers make production decisions more quickly.
Okay. Okay, understood. That makes sense. Well, good. Well, there's a few more questions. I think we're going to need to turn it off now, though, but certainly want to thank everyone for joining us. Remember that a recording of this webinar will be available shortly. And once again, I'd like to thank Dr. Mark Stephenson for his presentation, and also to Gregg McConnell and Corey Kayhart for their comments today. I just want to say, you know, certainly please check back the Knowledge Exchange section of the Farm Credit East website for information on economics, policy, markets. We published a Knowledge Exchange report here recently discussing some of the changes that producers can expect from the new tax law. So that's something that you can check out on the Farm Credit East website. Hope you'll join us 2 weeks from tomorrow for a webinar from our crop growers unit, talking about crop insurance and risk management options for producers. And with that, we'll conclude the webinar. Thank you for joining us, and have a great day.